Hey, everyone here at the Investing Stuff You Should Know podcast. We have a great guest with us today, a local talent. I love bringing on local talent. This is Ryan, and he is a local CPA. He actually works for a larger firm in the country, Brandon Hall, and he has a large team. I think what's that what is that? Help me out there,
Yeah,
Ryan.
tax smart insiders, tax smart real estate investors. Yeah.
There we go, man. That's the one here. So yeah, that's I love that community. I love what you guys have done, and I love that you're part of that. So give us a little intro, Ryan, about did you grow up here in Minneapolis, and what did you do after college, and how'd you connect with this awesome group and the things you do now?
Yeah. So I'm Ryan Carriere. I'm a CPA, senior tax advisor at Hall CPA. So all I do is really talk with clients, advise them on tax strategies. I'll get into more of that in a minute. But yeah, I'm from Minnesota, grew up in Apple Valley, Minnesota, and went to college at the University of St. Thomas right after high school. And then from there, I worked at a couple other firms beforehand. And then ultimately, kind of throughout my career before coming here, decided that, hey, I want to be a real estate specific CPA and tax advisor. It took some time for me to get there. And it's funny because the first time I talked with Brandon was 2016, pretty much right around the time that he was jumping into his firm full time, but I was working at Honeywell at the time. So I got my CPA while I was there and then kind of transitioned into more other CPA firms. But yeah, Minnesota local, Minnesota native, lived here my whole life. Me and my wife still live here. We're in Bloomington right now. Love real estate investing, kind of got into that through Bigger Pockets, through a friend that kind of referred me to Bigger Pockets and like, hey, you should listen to these podcasts, watch their YouTube stuff. So got into real estate that way, and then kind of just combined it with my CPA experience. And now I'm real estate specific tax advisor and CPA. So it's kind of marrying of kind of two different phases of my life into one. And so I tell all my clients that I love what I do. I really do enjoy what I do and get to help them save taxes as much as they can. And it brings me a lot of joy to see them kind of see the final result once their tax return is complete. And they're like, wow, I saved tens of thousands of dollars on a refund. I didn't really know this is going to work, but it did. So I love what I do. So yes, that's a little bit about me.
That's an awesome intro story there, Ryan. Um, what what for obviously the tax code is huge, and there's some people out there that say like learn the tax code and things like that. What's your advice to people that say that out there, or what's your recommendation? So you're a professional that lives in that space that it follows the latest trends and understandings and case law and all these different things. But then also as an investor, someone like myself that is an investor but doesn't know, does not intimate with all the tax details. What is your recommendation for how far an investor or even someone thinking of getting into it should go? Should self-educate and keep up to date on these things?
Yeah, a few things are bouncing around in my mind, but one is that you should be educated in some amount, whether that's coming through kind of a free form like my LinkedIn posts that I do. You're following someone that you think is knowledgeable, is an expert in the space, and you're kind of just learning things that they are talking about, and you're picking up on those things. You maybe invest a couple minutes every day, kind of reading new things or finding good articles or whatever. Or if you want to kind of shortcut that, right, kind of take some of that time that it'd take you to really learn all these things, then work with someone. Could be us, it doesn't have to be us, but work with a professional who basically can teach you one-on-one and advise you one-on-one to kind of, again, shortcut some of that time to speed up your kind of education to help you then start to implement things right away, right? Because a lot of tax and financial things are about kind of now versus later, right? As we think about cost segregation studies, maybe we'll get into that in a little bit. It's being able to take things from the future and applying them now, right? Similar to a 1031 exchange, I want to take income that I would normally have now, but actually defer that later. So all of these kind of things are about timing. So the faster that you can educate yourself, the more valuable that these strategies can be, and the more valuable that tax advisor can be. So I'd recommend, depending on if you're more of a do-it-yourself, hey, I don't have the funds to invest in an advisor, kind of teach me kind of one-on-one, great. Find some sort of means, depending on where you're at in kind of your investing career and financially and how much time you have. Figure out what is going to be the best fit for you. But being in the role that I'm in, I can significantly increase the time that clients need to really understand the most important things without them needing to understand all the case law, like you mentioned, all the real detailed things. And I can basically take, hey, here's your situation, here's what I know, and I'm going to marry the two, and here's going to be the best thing for you for this year, years in the future, and so on. So it depends on where people are at and what they're willing to pay for.
No, I think that's a good breakdown of kind of like the two different camps. And you did touch briefly on, like, just for example, the resources available. Let's just call it free content. And like, for example, I follow you on LinkedIn. You post amazing, awesome snippets and little lessons or big or small lessons for the day. But then also, Halt CPA has some really awesome, a Facebook channel, a Facebook group, and then some other content out there as well. So there's places to get some awesome content and follow along with these discussions that I would encourage people to investigate and to, at least have some awareness of, to follow. But you can see these really in-depth conversations are occurring out there. And of course, when it gets, it happens, the line is between then when it gets very specific and you need to know about you. But like the high level of education, you can just get so much deeper and more fluent in that. And I think that's super powerful just to know and to share that with people that may not be aware of those things.
Yeah. Yep. There's a range of free things, right, that are pretty generic. And then there's a range of the other extent, which is like working one-on-one with someone like we kind of talked about. And it's how much time do you have? How much are you willing to invest? Absolutely. There's a lot of free things out there. And to be honest, a lot of my clients come to us after they've gone through a lot of their own self-education, and then they come to us on the back end. Some of the time I do have to kind of uneducate them on things that they thought they knew, but kind of just misunderstood because it's quite generic oftentimes, because you're trying to help a big audience understand these things. But what does this really mean for you specifically? So sometimes it's a bit of uneducating them first and then re-educating them on what's appropriate. But absolutely, there's tons of resources out there. We're not the only ones, but obviously, we think we're really good in this space and feel like we're the experts in this. So yeah, happy to help people there.
That's awesome, man. That's awesome. So what how did you kind of get on the path of focusing in real estate, and why did that attract you, the real estate tax side of things here? Because obviously, we're taxed on everything, and but you were attracted to that space. Was that because you started to become an investor, or just to give us a little insight there why that was kind of just pulled you in?
Yeah. So because of my maybe timing of when I kind of started to get into investing kind of post-college, real estate was really booming, really around that time, post 2012, right? Things were starting to boom. We've had this pretty long run with real estate. So Bigger Pockets was really starting to boom as well. Their podcasts were growing a lot. So basically was getting free content, kind of like we were just talking about free content versus paid content. So getting a lot of just free content and learning. And then eventually was convinced that real estate investing was the way that I wanted to invest my money. That was going to be a big asset class for me. Primarily what I just came to understand was there's basically using leverage to grow cash flow faster than trying to get cash flow from things like dividends, right? So I kind of came to the conclusion, okay, wow, real estate has some big impacts on my investing, and goal for financial freedom is kind of the longer term kind of financial goal for us as a family. So I was like, okay, I want to get into real estate investing. So started to learn about these things, and then acquired my first rental property, a single family, with a buddy of mine in 2017. I think it was March 2017. Bought a single family. We house hacked it, lived in the basement, the two of us, split a bedroom, rented out the 3 bedrooms upstairs. One of them was an Airbnb.
By the way, I bought my first house in 2017 too. A small, happy little house in Golden Valley. But
yeah, excellent. Yeah, ours was in kind of the northeast Minneapolis area.
Yes.
So yeah, so had my first property, was kind of living and breathing the whole real estate investing thing. Liked what I was seeing, like really reduced my kind of just cost of living. So anyway, got into that. And then the next one was a 4-plex in Little Canada with a different buddy. And then just kind of kept acquiring with other partners. And then I was like, wow, this is really cool. This makes a lot of sense. Equity's growing, things like that. And then simultaneously, kind of at the same time, becoming a CPA and kind of seeing, oh, there's actually very unique things for real estate investors, things like real estate professional status, the short-term rental tax strategy, or loophole, some people call it. Cost segregation studies isn't necessarily only specific to real estate. but it is quite powerful for real estate investors. Things like that, 1031 exchanges, qualified opportunity zones, all those sorts of things were just very unique to real estate. And I was like, this is really cool. Like it's such a niche within tax and as a CPA that now I actually had this kind of world where I could combine the two. And that just got me really excited to kind of combine my education with an accounting and finance degree with my real estate investing. And if I could marry those together, I was going to be happy. And I am. I've really enjoyed where I'm at now.
That's an awesome weaving of the story there. And I think that the reason I asked you was for a particular reason, is because it's compelling, the fact that you should be in real estate and the fact that there are unique tax advantages. So I kind of pulled that out of you. And that's why, for the audience, he didn't just like stumble into this. He went into it because of a very specific kind of, he saw the value and the opportunity and the unique structure of the law and some of the other things. And that's why it's compelling. And that's why, folks like you and I get into the space. And that's why the government encourages it as well, is because they want to see housing, they want to see people in a stable environment and all these different other things that they encourage. And that's what they offer these things in the real estate space, which are, like you said, rather unique. They're not, there's other advantages and, maybe oil and gas and manufacturing and tech, but not quite as broad and as easily accessible like the real estate space is. So thank you for sharing that detail and breaking that down for us.
Yeah. And just a quick comment, as you mentioned, not really necessarily just stumbling into it. I do have quite a few clients who have kind of stumbled into this. They hear about real estate investing. They're like, this is really cool. And then they find out about us a month later or a few months later, and they're like, oh, I actually meet one of these strategies and I didn't even try to do this. So it's really fun to kind of pull clients in as they're like, oh, wait, I actually meet this? Yeah.
Yes.
And let me help you make sure you document it correctly, that you actually make sure that you meet this. I will help kind of verify and double check things for you, and then help you kind of see, how is this going to be tax saving for you? How do we get this to the finish line? All of those sorts of things. So it is some people who stumble into this, and it's fun to pull them into our ecosystem and kind of help them see how to actually maximize what they're doing, and just help them understand why and how this ties into their big picture financial goals, whether it's financial freedom or just more retirement income or whatever, diversification. Very fun to do that, even for people who stumble into this.
Those are great points as well. Then, like, if you had to even break it out even further at a higher level, we have like, appreciation, we have the tax advantage, we have leverage and appreciation, actually. So like it's inflation, there's like a lot of different pieces, moving pieces, and kind of a structural at a high level, just I guess value proposition, or kind of just the way it works with the money system and other areas that makes real estate compelling. And tax is like one part of that sandwich, if you would, that makes it so delicious to eat. So I know it's a weak analogy, but that's what I went with. Anyway, so let's talk about I think three things that I wanted to chat about. And these are kind of, I know they're talked about extensively, maybe even a little too much in many of the channels out there, but for the audience that maybe is new to you, let's talk about real estate professional status. Let's talk about 1031s, and let's talk about the short-term rental. Those things are just kind of popular. They're kind of buzzy. Give us the kind of the high level requirements and what those things do and why people talk about them so much, Ryan, if you would.
Yeah. So I'll start big picture. So big picture, we are in a tax world, where we are in this from the 1986 Tax Reform Act. Congress basically said all rental real estate is going to be by default passive. So with that, we know that generally with rental real estate, that it can usually produce a loss through depreciation, right? Depreciation is a beautiful expense that we get. It's basically an expense or cost for deterioration of the building that you've acquired. So we get this depreciation, which isn't actually a cash expense. It's more of a paper or tax loss or expense, right? So we've got losses over here that are passive, but for the most part, most of their income is going to be non-passive. So we have kind of these two buckets now. Okay? So I've got my income over here that's non-passive, but then I've got losses over here that are passive. So the default thing to keep in mind, big picture generally, is that passive losses can't offset non-passive income. So now we've got these two.
Great foundation, right, for everyone to keep that in mind.
Yep. So we've got these two buckets, and it's like, hey, they kind of can't cross for the most part. Okay. But What Congress put in place years later, after the 1986 Tax Reform Act came out for a while, is they basically said, okay, actually, we're going to give you some exceptions. One of them being a real estate professional status. Okay. So if you meet real estate professional status, and I'll get into what the details are of that in a second, but basically, if you meet that, it now takes your long-term rental properties, which were passive over here, and now you can treat them as non-passive. So now we are aligning our income and our losses together so they can offset one another. That is what we're trying to do with tax strategies. Okay. We're trying to align income and losses so they can offset one another. But without that strategy, they're separate, and any losses you generate that are passive basically are going to get suspended unless you have passive income, which is also possible with rental real estate.
For sure.
So that's the big picture. So basically, real estate professional status and the short-term rental strategy do the same thing. They pull short-term rentals or long-term rentals to the non-passive side. Okay, now we can offset non-passive income. So real estate professional status, in a nutshell, basically has two main steps. And the first step, I always kind of say it this way, the first step has kind of two parts to it. So basically, the first one is that you have 750 hours in a real property trade or business, and it's more than 50% of your working time. Yeah, so you have more time in real estate than anything else that you do. Yeah.
Right.
So right there, that 50% rule knocks out 95% of Americans, because most people have a full-time W-2 job, right? But for those people who are, let's say, real estate agents who work 100% of their time in a real property trade or business, that's not a barrier to them. And they are working maybe 2,000 hours a year in a real property trade or business. Being a real estate agent counts as one of them. So they've satisfied kind of the first step, 750 hours in more than half your time. But then the part that people usually forget or miss kind of for documentation purposes the most is material participation in your rental properties.
That's a big one.
That's a huge key distinction. And there's lots of tests to kind of identify, do I meet one of the material participation tests? The two most common that we see for material participation is, the simplest one is 500 hours. So do you get 500 hours in your rental properties? We're not talking about being an agent, completely separate thing.
Sure.
500 hours in your rental properties. Or another test that you could use, which is kind of the second most common, is you get 100 hours in your rental properties, and it's more than any other individual person, including like a property manager, any sort of repair person, a cleaner, right? Anyone. So as long as you get that floor of 100 hours and it's more than the next closest person, you've met material participation. So if you meet kind of all aspects of that, 750 more than half your time, and one of the material participation tests, you are a real estate professional, basically able to take real estate professional status. And again, that pulls your long-term rentals from being passive, and now they're considered non-passive.
Right,
yeah.
Right. And that's just a quick sidebar there. Many start in, like I started, I'll just make it personal here. I started as a W-2 employee. I was a mechanical engineer. And then I started to my side hustle. I think you kind of had a side hustle too. And then you went to it full time. That's what I did. I also went to this full time. So that's an incredible benefit. It just, if you find yourself as you have kind of straddling one foot into the real estate space, maybe you're doing, partners or Airbnb or any kind of that type of work, and then you're still kind of keeping your W-2 job, then you can see if it's right for you. And then if it is right for you, then you commit to it full time. And then you get this amazing benefit of the real estate professional status if you meet, like Brian was saying, all the different criteria, which once you leave your full-time job, it's relatively easy to, still within the guidelines to actually fulfill those obligations. I know I just wanted to mention that's kind of a strategy that some people may or may not see themselves doing, but that's it is an amazing way to go if real estate full-time is your calling.
Yeah. And some people, just to highlight something you said there, a lot of people I think will jump into real estate and just kind of think, oh, this is going to be huge tax savings for me. Well, let's think about this holistic kind of picture. Okay.
Yes.
Like, just don't jump into this for massive tax savings and then lose out on a bunch of other income, right? If you're making good money as a W-2 employee, maybe you like your work, you've got good benefits, right? You get lots of time off. If that's valuable to you, it doesn't mean quit your W-2 job or go half time just to make sure that you meet real estate professional status. So depending on all the factors, just to kind of go big picture real fast, keep in mind the bigger picture items too, not just the tax savings. I think a lot of people just put their blinders on and they kind of just want to focus on tax savings. So focus on the big picture first, and then figure, okay, does this make sense? And I want to go into this. So, but yeah. Anything else you want to say there?
One, just I think this is from you, maybe from Brandon, or just kind of that's a saying that kind of circulates in the circles. Is don't let the tax tail wag your life called the life called your dog, or the dog called your life. So make sure it's your life. You have the priorities, objectives, and the dream set correctly, and then you find out the tax strategies that fit in with that, because the tax savings will never. They're not going to generate income. It's not a value creation process. It saves value, and it saves, saves income and a bunch of other things there, but it doesn't actually lead out with the kind of, interesting, creative things that inspire you. It's just kind of it's the foundation part of that versus the actual thing that you see. So just
exactly. Yep. Don't let the tail wag the dog. Absolutely. Yep. So that's real estate professional status. And then I'll jump into short-term rentals. So short-term rentals are actually much more inclusive than real estate professional status. Why do I say real estate professional status is exclusive? Because of that, more than 50% of your time, and you have to get 750 hours in a year. Very few people can do that, is my point, right? Very few people can actually get more than half their time in real estate and can get 750 hours in a given year just in real estate. So to me, it's actually quite exclusive. Yeah. So then jump into short-term rentals again. So the short-term rental tax strategy, similar to real estate professional status, also has 2 steps. The first step is actually quite simple and has nothing to do with hours. The first step is that you have an average stay per guest less than 7.
Yes.
Okay? You need to have a minimum of 2 stays. Okay. Don't be caught having no stays, then you have no average, right?
Yes.
It's a 0. Okay. So you have to have some stays, at least 2. But the average, if it's less than 7, you're renting it like a vacation rental. Great. That is the first step. And again, like I said, nothing to do with hours so far. Okay. So far it's quite inclusive. Okay. But then the second part is going to be material participation again. Okay. But keep in mind, same test. So I'm not going to run through them again, but keep in mind material participation as you think about those hours in your short-term rental or short-term rentals, if you've got multiple. Those are completely separate hours from your long-term rental properties for real estate professional status. We can't group long-term and short-term rental hours together for material participation time. So keep that in mind. But basically, if you have an average stay less than 7 for a specific property, Airbnb, VRBO type property, and you actually materially participate, awesome. You now have a short-term rental that now, again, big picture, moves from being a passive property to now be considered a non-passive activity. So then if you do a cost segregation study, for example, and you maximize your losses from the property in that first year, that can offset things like your business income, that can offset your W-2 income. And this is exactly the strategy that I'm planning to use. Okay, for 2023.
Give us the goods. Give us the secrets, Ryan. Come on.
So, well, one other thing I'll add in there. If you remember what I said a few minutes ago, material participation, you've kind of got the 2 tests. So the first one is 500, and the second one I mentioned was 100 hours and more than any other individual person. Okay. So for 2023, I'm not planning to hit 500 hours. If I get there, awesome. But my barrier to entry to meeting the short-term rental tax strategy is I need to get a minimum of 100 hours.
Yes.
That is not a lot of time.
Yeah.
Being married with my wife, we can combine our hours together.
Oh, wow.
We could literally knock out material participation in a week, right?
Yeah.
So I could spend 1 week of work getting this up and running, doing any repairs and renovations, getting my listing up, doing all those things, acquiring the property, and boom, I could meet this. I'm saying that a little over, maybe overselling it a little bit, but I'm just trying to draw kind of this drastic distinction between how low of a barrier of entry it is for the short-term rental strategy, which is already in an inclusive test, compared to real estate professional status, which is by default very exclusive. Yes. So to me, any of your listeners who are W-2 employees and love rental real estate and are okay getting into the market of having a short-term rental portfolio, if they're okay to hold on to that kind of a risk, right? Things could be changing. That is going to be the best real estate specific tax strategy for them. add on a cost segregation study to that, and you are going to have massive tax savings to offset your W-2 income or business income.
That's amazing, man. That's so amazing. Since you mentioned it, and some people may not be familiar, or maybe they are familiar, they just want to brush up on it. Talk to us what a cost segregation study is and what it sounds very intimidating. Sounds like these big words, but also we know that it's not. And also that there's, it does cost something to get a study, but also it's fairly reasonable. The tax savings could be fairly substantial to get it. So talk to us what that is and how that process normally would go.
Yeah. So first, it's figuring out, does a cost segregation study make sense? It doesn't make sense for every single person, for every single property. But if you've got enough basically basis in your property, if your acquisition price and the building basis is significant enough, and you're going to get a good amount of bonus depreciation or accelerated depreciation, then it could make sense, okay? And depending on your tax bracket and all of those things. But basically what a cost segregation study does is it takes your building, which would normally get depreciated over 27 and a half years for a long-term rental or 39 years for a short-term rental or other non-residential property. And basically what it does is it says, hey, instead of all of your kind of building basis being allocated to that really long useful life and depreciating over that time, we're actually going to help you figure out through this study what amount of your building or purchase needs to be allocated to 5-year property and 15-year property. Okay. Why that's important is that 5 and 15-year property in the current tax law is eligible for bonus depreciation. A lot of folks don't know what that is. Essentially, it's a special type of depreciation that we've been given by Congress to say, hey, you can accelerate this type of property's depreciation. Okay. Really, the bigger picture rule is that it's anything with a useful life less than 20. The life is designated by IRS. So don't think that you can make this up or something. But if it's got less than that, less than 20, that's why I say 5 and 15, then we can accelerate that. The big thing to keep in mind, though, as you've maybe first determined, okay, I'm going to do a study. Here's how much maybe it could help me produce as far as additional depreciation in the first year, is that as you think about right now or moving into the future, the bonus depreciation percentage is going to be continuing to decrease. Okay, it's decreasing by 20% every year starting here in 2023. So what that means is that in 2022, if you had acquired and placed a property in service in 2022, that was the last year for 100% bonus depreciation. Yes. Now, 2023, now we're at 80%. Okay, and it just keeps moving down 60, 40, 20, 0 every year until we get to 2027, and it's going to be a big fat 0%. So unless Congress and our politicians change the tax law again, and they want to re-up and say, forget this kind of whole phase out, we're just going to keep everything at 100% or 75% or whatever it is, that's what we have to deal with. So as people are thinking about timing of acquiring a rental property, yes, now is better than later. As you're thinking about the big picture tax consequences, now is better than waiting 2 more years, because you're going to get essentially half of the benefit, 80% versus 40% if you wait another 2 years. So keep that in mind. It's very important to be understanding that. But hopefully that answers the question of kind of what is it and how does it work?
That's awesome, man. Yeah. And you actually mentioned at the beginning of the show the importance of timing and how this, like the current state, of course, taxes that we take care of now, or looking back 1 year, but also the forward looking is also like this timing based thing. So that timing is super important when you're looking forward. And then also there's like changing rules and laws. Like you said, it's last year, as far as this unique program or unique opportunity called cost segregation, which I know, keeping it really simple in very simple language, with 100%, you could take advantage of 100% of anything, like you said, it's it has a 5 or 15-year life. Now this year you're only going to be able to take 80%, like you explained, of anything with a 5 and 15-year life. And just to give people just a little bit of context there, so let's just say the normal depreciation would be over 27 years. And it would be like the framing, the siding, and then the actual structure, the foundation. Something with a 5-year lifespan, maybe that's appliances, so that's going to be worth X percentage of the amount of your building. So let's just say your fridge and your stove and things like that is 10 grand. Well, there's something that would have a 5-year life, and you're going to be able to take that, like you said, that depreciation, accelerate that. So that's what, just kind of to give people a distinction of like, well, what part of my building is the long versus the short, and this, that, and the other. that's the kind of things that you can think about is like, the carpet, has a shorter life, the furniture, or not the furniture, but like the appliances have a shorter life. So just give people a little bit of an actual idea of what we're talking about. So I think it's important. So,
Yep. Yep. And 15-year, just a quick example would be land improvements.
oh,
So that
okay,
would be
yeah,
things like decks or sidewalks and things like that. It's kind of things on the exterior on the land that are improvements like not grass. Yeah.
beautiful, man. Talk to us about kind of the final wrap up here. So I know we're talking hitting the high level stuff that get people excited, but also talk to us what the 1031, if people get closer to real estate, they hear about it. Some people are more sophisticated or been around the space and they know what it is. Talk to us, explain to us what a 1031 exchange is. Again, this kind of high level things that people get excited regarding tax planning and tax strategy goes.
Yeah. So big picture, a 1031 exchange is going to help you defer a gain from selling a rental property. Okay. So if you've had this property, let's say just 5 years or something, right? If you've had a property for 5 years, and let's say you have a $250,000 gain, then what a 1031 exchange, if you meet all these requirements, and we can get into this in a second, is basically going to allow you to take that $250,000 gain, and instead of just selling the property and then paying tax on this 250,000 gain, you're going to basically roll the proceeds into another property. You're exchanging from one property to the next, and you're going to defer that gain to potentially doing a sale of that new property in the future. Otherwise, you can continue to do 1031 exchanges just indefinitely until you pass, right? Defer, die, swap till you drop, sort of a thing. That's kind of common phrasing that we use. But that is a strategy, but that's big picture first. That's kind of what it does. You're deferring gain from selling a property, and you're putting that as basically into another real estate. Yeah. But the tests that the IRS kind of wants you to step through in Congress is that the first thing is that you have to identify property, usually about 3 property that you would acquire, basically 3 properties within a 45-day time frame. So you sell the property, let's say, I'm going to do terrible on the math here, July 1st, right? 45 days from that, a month and a half, July, August 15th, right? Yep. So by August 15th, you have to identify the properties that you would potentially exchange into. Okay. So 45 days to identify, but then you have 180 days from the date, again, the date that you sold that property, 180 days to actually close on one of the properties that you identified in that 45-day time period. So it's quite kind of like these deadlines and timelines that you have to meet, but it can be a huge benefit depending on how much gain we're talking about. Okay. So 45 days identify, 180 days to close from the time that you sold that property. If you do that, and if you basically are going up in value, okay, and your debt is going up as well, okay, then we don't usually have any big issues of recognizing any sort of a gain, okay? Then we can theoretically defer all of the gain from selling that first property that we talked about. But some people will get kind of caught because either one, they are actually trying to do a 1031 exchange. I saw this at a previous firm, trying to do a 1031 exchange on a property that they actually had a loss on. Okay.
Oh, wow.
It makes 0 sense, in my opinion, to do that. I can't necessarily think of a good reason to do that. Maybe very unique and nuanced, and nothing's come into my mind. But first, make sure that you have a gain. Work with your tax preparer, tax advisor, make sure you understand how much your gain is, and then figure out, okay, I have to pay this kind of qualified intermediary, right, to hold these proceeds for me from the sale and basically use those. So you can't touch the proceeds. That's another part that I've kind of missed. But basically, do I want to do this if I've got a $10,000 gain? Okay. Putting yourself in these really tight time frames and paying for someone to do this and paying for your tax preparer to walk through the forms of a 1031 exchange, right, the benefit to you after figuring out your tax liability might not be worth it to you. So first, figure out what is going to be your gain. Then from there, figure out what kind of a market am I in that it actually makes sense and it's possible for me to do a 1031 exchange, right? In a seller's market, it could be very difficult to do a 1031 exchange because you are going to have a ton of competition for people looking to buy. Okay. So be cognizant of 1, the gain, 2, what type of market you're in, and does this even make sense? It sounds sweet. It sounds great, but with a lot of things with tax and investment, there's always kind of a bigger picture thing to be thinking about. It's more than just, oh, do I have tax savings? A lot of people hear 1031 exchanges, like you said, and they get really excited. Let's take a few steps back and make sure that this makes sense in the first place before we put ourselves into these really tight timeframes to meet the exchange requirements.
I love those, thinking about those second and third order consequences, or even like kind of the pre-work that needs to go into these things that people get excited about, and they are exciting in the right situation, in the right context, in the right, the things. There's a lot that has to be set up correctly for these kinds of things to work, and oftentimes they do, but oftentimes they don't as well. So that's why it's important to talk with someone like yourself for this kind of guidance. And oftentimes just it's a different level of kind of thinking. Like, the real estate is you're running a business, and you need the kind of professional service that you offer to facilitate that. And the savings, like, oh, I don't want to, that's too expensive. But oftentimes we're dealing with such large amounts of money, just to be frank about it, that oftentimes the savings are, even though it may seem expensive, the savings will be significant, to either do it and actually realize it, or actually save yourself the stress and the nominal gain or even loss perhaps that you would take otherwise.
Yep. And we take on new clients, regularly, and oftentimes we find, not every single client, but sometimes we do find mistakes from other tax preparers who aren't sophisticated or understand all of the real estate specific tax strategies and how they should look and why they're important to folks who are in real estate investing. And so working with us maybe on the front end actually would have saved them on the first year that they're starting to do this, or the second or third, rather than, hey, you've been doing this wrong for a decade, and now we have to do this big correction. And to do this big correction, number one, you would have saved all this tax over the course of those 10 years. You'd have more money in your pocket now. But number two, now we're going to have to potentially do this big fix, and it's going to be a huge headache. It might be costing you more anyways. So sometimes getting set up correctly, working with the right tax advisor, tax preparer in the first place, can actually save you long term. So if some of your listeners are kind of new into this and they're like, I don't know if I can justify this, that's fine. Okay, that's up to you. That's your decision. But for those of you, especially for my clients who are young and are looking to grow significantly, we are a good partner for those folks. So yeah, good fit for someone like us. We can help you kind of maximize, set things up correctly from the start, help kind of educate you, again, shortcut some of that time to learn, and make it very specific to your situation. So you know what to document, what you don't need, what's going to be relevant, where to focus your efforts, and we can help people like that grow significantly.
All right, folks, you heard it straight from Ryan. Pay for that service, pay for that help, get it set up right, get set up for the long term, and the returns will be less stress, hopefully very little stress, and a really, really solid foundation from the tax part of your financial life, which, as we know, is a huge part of our life in general. It ties into so many components of that, and you don't want to be worried about missing things, you're doing it incorrectly, and also missing out on maybe savings and opportunities that otherwise could have been realized or gained. So this has been so awesome, Ryan. Thank you. We could obviously just keep talking about taxes and other subtopics within it, but we'll wrap it up here. What's the best place for folks to get in contact with you and to follow along and maybe even learn about what you do and the kind of help that you provide to folks?
Yeah, the best place is LinkedIn. So it's Ryan Carriere, CPA. You'll see me. I post on there every day that I work. So not weekends necessarily right now, but lots of content, usually writing about new things, writing about kind of new things about kind of real estate professional status or the short-term rental strategy, kind of new ways to think about that. 1031 exchanges sometimes, cost segregation studies, all of that. So LinkedIn is going to be the best place to find me. And from there, we can kind of be in touch and figure out what would be potentially a good way for us to work together if it's good mutually. So yeah, LinkedIn.
Beautiful, man. All right, everyone here at the Investing Stuff You Should Know podcast. Thank you for listening to another episode. Thankful that you made it to the end of this episode. If you see us on YouTube, give us a thumbs up, spread the word, and until next time, we'll sign off right there. Ryan, thanks, man.
Thanks, Johnny.